I know there are a lot of accounting students here. The main topic was supposed to be financial statements, but obviously we saw the election yesterday and a lot of other volatile events happening. So Max and I have a lot of stuff to discuss throughout this meeting. If you want to go to the next slide. Here's the main topic of this meeting. The markets have been super volatile, election happened, so let's talk a little bit about that. I know some of y'all are unhappy with the election. Maybe your candidate didn't end up winning. But there is some good news. Markets have been super green today. Crypto's been super green. So we're going to be talking about some of this stuff today.
Yeah, and for starters, let's look at the S&P. So in the past week, we've been up 1.76%. And as you can see, it's mostly been the last 2 days, and especially after the election finished and Trump was elected, the S&P did see a lot of rise. And this just shows that investors were pretty confident in this, and looking forward that there's going to be a lot more opportunities in the future for further investments.
Yeah, so I'm not sure if y'all are familiar with the VIX. The VIX is a volatility index. I've talked about this in a couple past PPM meetings, but essentially it measures short-term volatility. So the risks in the index. Are investors bullish or bearish on the market right now? We saw the VIX went above 20 points. So in the last week, the VIX was above 20. What does that mean? It essentially means that investors are fearful in the short-term market. So they think that either we're in a bearish economy or short-term, we might see some volatility. However, after the election, the VIX fell 20%. When the VIX falls, it's actually a very good sign for the economy, because now investors are more neutral, even positive about the economy, for the short-term economy. So following the election, just yesterday, investors reacted very positively. So let's talk a little bit about what's going on. The election was not the only thing that's happened in the past couple days in terms of stocks. We saw big tech earnings, so a lot of the Magnificent Seven companies, they had their earnings in the last couple of weeks. We saw a jobs report. So the first Friday of every month, the BLS releases a jobs report. It tells a lot of stuff about current wages, the amount of jobs added, unemployment rate, etc. Election, obviously the election happened yesterday. Like I mentioned, you might not be happy, you might be very happy. We're going to talk about the impact on the stock market. And then there's a Fed meeting. So the FOMC is meeting today and tomorrow. Tomorrow we're going to find out the news, and Jay Powell's going to speak about potentially having rate cuts. The main thing about this meeting, expect volatility. We've seen a lot of volatility in the market in the past 2 weeks. We'll probably continue to see a lot of volatility, so we'll talk about some investing strategies later throughout this presentation. Okay, so let's detail the jobs report. What was it? First Friday of every month. So like last Friday, we saw the October jobs report. This was a very, very disappointing jobs report, but the market actually reacted pretty positively to it. For starters, we saw the unemployment. This was a good sign in the jobs report. The unemployment rate was maintained at 4.1%. So pretty positive sign. But the reason that it was so poor was the number of jobs added. So we were expecting to add 112,000 jobs in the month of October. How many jobs did we actually add? Only 10,000. So if you look at this very, very small bar is the number of jobs added compared to the previous month. So very, very disappointing. Obviously, a huge outlier from all the other months. Some of the main factors, we obviously saw a hurricane. My family lives in Tampa, so I'm very close and dear to these hurricanes. And then we saw port strikes, we saw Boeing strikes. A lot of this stuff factored into the huge decrease in number of jobs added. The market did react positively to this because the unemployment rate and some other factors in the jobs report signaled the rate cuts that could be happening tomorrow. So let's talk a little bit about the election. Obviously, this is a quick summary of the election. Trump won the Electoral College and the popular vote. So let's look at some of the factors and how does it affect the stock market. One thing to consider is 2024 has been an amazing year for stocks, considering it's an election year. The markets are up over 20% And if you compare that to any other year in the last 70 years, any other election year in the last 70 years, this has been the most positive returns. Obviously in 2008, we saw horrible returns. But besides that, every other year has seen like 8 to 10%, 8 to 12% returns. This year has seen over 20% returns, and we're continuing in a bull market. This year has been fantastic. Now, one thing to note is the year following elections, so the 1 year after an election, so let's say next year, the market averages 10 or 11% returns. So we've already seen a 20% return this year. It could go even higher. The next year, it averages 10%. So how long will this bull market last? I think an average bull market lasts 2 to 4 years, something like that, maybe 1 to 3 years. How long do you think this bull market is going to last? It's going to be interesting to see. But we're definitely in a very strong bull market at the moment. One thing I want to point out is DJT stock. I don't know how many people know this, but Trump actually has a publicly traded stock. And it's basically like a social media, I think it's like a social media platform, because he believes that a lot of the other platforms have censorship issues, so he made this company. This company actually operates at a $20 billion net loss. So this company is shredding money. They're losing a lot of money, but their stock has seen insanely high returns. It's just matching the returns or the odds of Trump winning the election. So as the odds of Trump winning the election increase, the share price also increase. So I thought that was really interesting. There are a ton of other stocks like that. Does that mean you should invest in it? When a stock has to be halted because it's so volatile, I don't know if you want to invest in something like that. They had to temporarily stop trading on the stock yesterday because it was so volatile. Is that really a secure company you want to be investing in? Me personally, no. Some people probably saw good returns on that. But I thought it was really funny to see that.
Yeah, and moving on to sectors in the financial market that we believe Trump's election will positively influence. So for the first sector, we have energy. And as some of you may know, Trump has been a big advocate for oil. He's always said that he supports oil fracking, and in general, the Republicans have always been a big backer of U.S. produced oil. And also Trump's planning to add a lot of tariffs on imports, which will likely decrease competition for U.S. oil companies and see a lot of rise in the energy sector because of that.
Max, if you go back one slide, these are the returns from yesterday. So yesterday, following the election announcement, we saw these returns. I took this screenshot this morning. Financial services up 6%, energy up 3%, industrials almost 4%, tech 2.6%, consumer cyclical 2.8%. Just a couple hours after the election, the entire sector was up 6%, 3%. That pretty much means investors are confident that these sectors will perform well under Trump's administration. So this is a clear indication. Real estate, consumer defensive, utilities, maybe these won't perform as well under Trump's administration, but the ones in dark green, investors are more confident on those. So let's talk a little bit about the financial services.
Yeah, so financial services is another sector that we believe will be positively influenced by Trump's election. And this is because historically Republicans have been a big supporter of less regulation for banks. So banks like Bank of America and other banks will definitely have more room to grow. And
yeah, so it's not just the large big banks that you see. It's not just the Bank of America, the Wells Fargo, whatever, JP Morgan. It's not just those. I saw a stat today. The regional banks, so some of the smaller banks, they have an ETF composed of a lot of the regional banks in the United States. That ETF, composed of like a huge sector of just regional banks, was up 10% today. 10% is not a small number. 10% is a really, really big number, just showing the impact of Republican Party on the financial services sector.
And another big thing we wanted to touch on today was cryptocurrency. And obviously, right here we have Bitcoin. So Trump himself has been a big holder of cryptocurrency and a huge advocate. He said himself that he wants to turn the US into the capital of crypto. And we can clearly see that here as just in the past few days, Bitcoin jumped almost 7%, which is been a really large jump because Bitcoin's been around for like 10 or so years, and it's always been on the rise. But this is especially recently, this is a big jump for Bitcoin.
Yeah, Bitcoin has been something that's on the top of everyone's minds for the last 10 years. And to see a 6% gain in one day, that's got to show bullish signs for the next couple years under Trump's administration. Investors are expecting some big changes for crypto to happen under Trump's administration. We saw crypto ETFs came out this year. That was huge for Bitcoin and other cryptos. Bitcoin has been, I think it started the year maybe at like 20 or 30,000, 75,000 now. Every day I live, the more I regret not investing in Bitcoin, but the more I'll continue not to invest in it. But that's how it is. So it'll be really interesting to see how it performs the next couple of days and next couple of months as well.
And another thing to note is that along with Bitcoin, companies like Coinbase and Robinhood, which allow you to trade Bitcoin, have also seen a large jump in stock price recently because of all this hype around Bitcoin. Because people are going to need somewhere to trade Bitcoin, and these places are perfect for it. So these are also something to look out for in the future.
Yeah, pretty much everything was in the green. I'm not joking when I say that. I think I saw all the futures were in the green. I saw the value of the dollar increase. Crypto, all crypto trading platforms, so many sectors, I think all except like 2 or 3 sectors were in the green. Investors reacted very, very positively to this, even if the average American didn't. One thing I want to point out is purchasing forecast contracts. I'm not sure how many of y'all participated in this, bought some forecast contracts. Did anyone do it? Raise your hand if you did. No one? Oh, you did? Okay. Who'd you buy on? Don't mind asking. Trump. So you made some money. Okay, yeah. Trump was leading in the polls. I took this screenshot like 2 days ago. Essentially what it is you could bet on who's going to win in the election. So you could do this through Robinhood or some other smaller brokerage firms. You could bet on who's going to win the election. So it takes the polls or the likelihood of winning, and if you invest in, or I don't want to use the term invest, if you bet in it, you can get good returns. So at the time of the screenshot, Trump was leading about 60% to 40%. So if you bought one contract for 60 cents on Trump and he won the election, you would have made 40 cents or $1 in total. Had he lost the election, you would have lost all your money. Same thing with Kamala. If you bought it for 40 cents and she won, you would have got 60 cents profit, and if she lost, you would have had 0. My question to you is, how is this any different from sports betting? This is not investing. Just because it's through a brokerage account doesn't mean it's investing. It's simply betting. You're taking the odds and you're betting on someone to win. If you lose all of it. That's what betting is. If I go to blackjack, I'm hoping to make big return. If I lose my entire bet. So that's not investing. Let's look a little bit as to how Robinhood gets away with this. So one thing to know with Robinhood is, who do they target? I know a lot of people, when they first start investing, Robinhood is the go-to platform. It was for me. It's a very easy platform to use. They give you free money when you sign up. Everyone sees, oh, $5, that's free money. I love it. I'm going to sign up. Robinhood is good to go. Really easy to use. You can trade options. You can do it super easily. But they target these uninformed investors. Lots of the big investors don't use platforms like this because what Robinhood does is they have this thing, they take advantage of this thing called the bid-ask spread. If you're not a finance major or you never invested before, you're probably not familiar with the bid-ask spread. But essentially, the bid price is the lowest price the seller will accept, and the ask price is the amount of money a buyer is willing to pay for a security. The ask price will always be higher than a bid price. So when you go to buy a stock, when you click buy or trade, you'll see an ask price and you'll see a bid price. The ask price is the price that I am buying the share for. So if I go to buy NVIDIA, and let's say NVIDIA is $145 a share. If I wanted to buy it, maybe the ask price would be $145.10. And maybe the bid price, if I wanted to sell it, would be $145. So if I bought and sold it right away, I would actually lose money. because of a bid-ask spread. So let's look at an example of this. This is NVIDIA. I took this screenshot yesterday from Robinhood and Charles Schwab. On Robinhood, I took it at the same time. On Robinhood, the bid price was $140.41, and the ask price was $140.50. On Charles Schwab, it was $140.16 versus $140.17. So one thing to note is that price is a little higher, and the bid-ask spread is higher. So the difference between the ask price and the bid price. Versus on Charles Schwab, there's only a 1 cent difference, and it's lower. Not a lot of investors will know about this. I didn't know about this until my professor taught me this in a class 2 months ago. It's not really something you notice unless you're actively looking at different platforms. So you don't really realize this. But this is a way Robinhood takes advantage of their investors. Yeah, it's an easy platform to use. Yeah, you get a free $5 when you sign up. But over time, you might be losing money due to this bid-ask spread.
And moving on, let's talk about the big tech market. As we mentioned at the beginning of the slideshow, big tech had a lot of earnings drops in the last week, and let's see what that means. Now first, let's discuss what is earnings. So usually when a company releases earnings, there's a set date, and during that date they'll publish basically how much money they've been making in the last quarter usually. And the number one metric well, not the number one, but a popular metric to measure this is the EPS, or earnings per share. And what essentially this is it measures how profitable the company is, and it also measures how much they're making per share of the company. So they take the earnings of the company and divide it by the shares outstanding for that company. And usually in practice, it's a little small, but especially on Yahoo Finance, if you look at the graph, if you find a blue circle, that's usually where the earnings are. And the earnings will have two main numbers, the EPS estimate and the EPS actual. Essentially what the EPS estimate is analysts at Wall Street or other places will do their own research on the numbers and figure out and try to give an estimated price for their earnings. And then on the day of earnings, the company will reveal their actual earnings. And the percent difference is your EPS surprise. And so that means that a company can beat earnings, making more than predicted, meet earnings, making about the same, or lose out on earnings, which means they make less than what was predicted. And this can often influence the price of the stock, especially for the next few days.
Yeah, EPS is just one metric used for earnings. There's also revenue, forecast guidance. What is this company doing to grow? This morning I had a chance to speak with the CEO of the company I'm interning at next summer, and he told me one of the main things to look at in clients or in companies to invest in, how are they investing in technology? What are they doing to grow, right? Versus just, are they meeting their targets? What are they going to be doing in 5 years? We're investing in this company for a long term. I'm not investing it just to be earnings. That's a gamble. I'm investing in this company for the long term. So what are they doing to grow? Are they investing in AI? Are they investing in technology? Are they investing in research and development? How is this company growing? So this is stuff that's talked about and asked in earnings call. When companies report earnings, they do it over the phone call or a video call. So you can actually join these earnings calls. I don't know if you have to be an investor in the company, if anyone can join it, but you can join these earnings calls and listen into the CEO or some of the top C-suite executives share some of the company statistics. So this is a really interesting time to hear those analysts ask those questions to the company and get a little more insight into what this company is doing to grow.
And moving on to the actual big tech stocks. So here we have 4 of the Mag 7. We have Tesla, Microsoft, Meta, and Apple. And originally, before the elections, these were all down after earnings. However, as you can see, Microsoft and Tesla did jump a lot after the election, so those are kind of an outlier right now. But let's focus on Meta and Apple. So for Meta and Apple, they didn't necessarily beat earnings by a ton, but they did meet or barely beat earnings. And despite that, the stock price dropped. Now, this might confuse a lot of you guys because if a company is making money, why is the stock price going down? Well, one, there's a lot of fear before the election, so people wanted to cash out before the stock prices were either going to go way up or way down because they were unsure. But another thing, as Sanj said, was their forecasted guidance. Basically, how is the company going to grow in the future? So while the two companies, they did make money, but their growth was slow, especially compared to previous years. Instead of every year gaining a little more and more each time, they were still gaining, but by not by that much more each time.
Yeah, we're going to do a little deep dive on Apple later throughout this presentation, so you'll get some more insight onto how they've been performing.
Yeah, and another thing for forecasted guidance, especially for these big tech stocks, is going to be AI. And I'm sure everyone here has used AI, whether that's ChatGPT or some other form of AI that you don't even know is in your life. And AI is so powerful right now, and for these companies, it's basically a race to see who can implement AI into their company for better growth. Take Meta, for example. There's been some news on the low that Meta has been trying to develop their own AI for their personal company. That way they don't have to outsource this AI to other companies. That way all the growth is controlled and within their own grasp. And so this is important because for a company like Meta, if they're able to successfully create an AI and have it be self-sustained, then they're going to have a lot more potential in the future versus a stock like Apple, who hasn't really taken an initiative, or at least we don't know of it right now, to make their own AI. And here are just the other stocks of the Mag 7. And these were ones that beat earnings because, one, they beat earnings by a decent amount, and two, they showed a lot of growth from the past few years. Like, every year they've been gaining, but this year especially they've gained more. And so investors saw that as a positive sign, and so the stock prices went up shortly after. And another thing to keep on the lookout on your calendars is the November Fed meeting. Now this is going to take place, I believe, Thursday and Friday of this week, so like literally tomorrow. And during this meeting...
Today and tomorrow.
Oh, today and tomorrow. And during this meeting, right now investors are predicting a 25-point basis cut. Now, if you weren't here at some of our previous PPM meetings where we talked about the previous Fed rate cuts, last meeting they cut it by 50 basis points, which is 50%, like 0.5. And so that was a large cut because during that time, people were really fearful, and the Fed was fearful of inflation getting out of control. But now that the markets are relatively more stable than they were before, the Fed only plans to cut by 25 basis points down to 4.6%. And right now, investors are hoping that the Fed takes consistent and continuous rate cuts to keep inflation under control without inspiring too much fear within the market. And in the future, the Fed is going to have another meeting in December where, again, investors are hoping for a 25-point basis cut. And they're going to keep doing this over the next few months, especially next year, to just regulate inflation, but while keeping the market stimulated at the same time. And the biggest, again, I've already said this a couple times, but like the biggest thing is people are scared of a 50-point basis cut because that means the Fed thinks that the economy is going to go down a lot, and so they need to pump more money into the economy to prevent that.
Yeah, one thing to know about the rate cut is investors are expecting a 25 basis point cut. I saw a stat saying investors are expecting there's like a 99% chance of a 25 basis point cut at the FOMC meeting tomorrow. So if we don't get this expectation, you might see some negative reactions in the market tomorrow. We're in a very, very high bull run right now. Tomorrow, we could see some volatility following this news if we don't see a rate cut. So it's definitely going to be interesting to see. I'll probably put some news about it tomorrow in the group me, so like the message if you see it. Yeah, it's definitely important to keep an eye out for. This will continue for, I believe, the next 1 to 2 years. So it's not something that's just going to happen tomorrow. We won't hear about it again. The Fed is going to keep cutting this rate over time for the next couple of years. So what's my strategy? I've talked a lot about how the markets are super volatile. Everything's going on. We have the big tech earnings that just finished. We have the jobs report. We had the election, obviously, yesterday. And we have the Fed meeting tomorrow. What's my strategy? What do? Do I invest in this bull market and hope to get great returns? Do I keep my money safe because I think the market's going to go down? Why not just stay in the market? We've talked about this a lot of times. match the returns of the market. Invest in an index fund that matches the returns of the market. I was literally talking to one of my friends today, and he showed me all these different stocks in his portfolio, and I asked him, what's your year-to-date return? He showed me, I forgot what the number was, but it was about 15% less than the return of the S&P year-to-date. Now the S&P returned about 20-25% year-to-date, so do the math, figure out what that number was. But 20 to 25% returns, just matching the market, is really, really good. If you had $10,000 cash and you put it in a savings account, maybe you're having $10,400 cash at the end of the year. If you have $10,000 cash, you invest it and see that 20-25% returns, you're having $12,500. Pretty good return versus just holding it cash in a savings account. So why not just match the returns in the market? 94% of investors don't beat the returns of the market. So what makes you think you can? If 94% of investors can, why do you think you're one of the 6%? Why do I think I'm one of the 6%? Why does Max think he's one of the 6%? Why do our professors think they're one of the 6%? We shouldn't. Match the returns of the market, invest in an index fund, whether it's a global index fund, whether it's the S&P, whether it's the NASDAQ. Invest in the index fund. Now, do I just dump all my money in the index fund right now? Yeah, stocks are green, crypto's green. Do I just dump it in an index fund? Maybe that's not the best strategy. There's something called dollar cost averaging. Slowly putting in your money over time. So maybe you put however much money you have, divide it over time. So maybe you put X amount this week. You put the same X amount in 2 weeks. You put the same X amount in 2 weeks. Same in another 2 weeks. Same over time. That's called dollar cost averaging. You'll match the returns to the market, and you'll have more exposure to the market. So if you don't want to invest in all-time highs, you can invest over a period of time and match the returns to the market. 25% returns is pretty good for someone who doesn't have to do anything except invest a couple, whatever they can afford, every 2 weeks, every month, whatever. I would take that. So now let's move into our fundamental analysis. How many people are here for the accounting extra credit? Okay, a couple people. If this is your first time at PPM, we're teaching something called fundamental analysis strategy. It's one of the main investing strategies used by all the top investors. I'm sure some of y'all have heard of Warren Buffett. He preaches fundamental analysis. He preaches investing in index funds, these low-cost index funds, and understanding what a company does before you invest in it. So at one of our last PPM meetings, we taught how to use Finviz. Finviz is essentially an online screener to help you find stocks. So you enter certain criteria, and it'll give you a large batch of stocks that meet that criteria. Now we'll move on to the second and third steps. Looking at the business details and the financials of a company. So we're gonna analyze those annual reports of a company. We're gonna analyze the financial reports of the company. And then at later meetings this semester, we'll go over the strategy and the valuation of a company. So let's look at the annual reports. I'm going to do a live walkthrough of Apple, but one thing I want to note is, what do you look at annual reports? What are they? The main way to look at them is on the investor relations page. Anyone, if you pull out your laptop right now, you can find all the SEC filings for Apple. You can find all the annual reports, you can find all the quarterly reports. You don't have to invest in Apple, you can find it in 10 seconds with a Google search. Once you're on that investor relations page, you open up the 10K annual report. Then there's some different categories you can look through. You can look through the business overview, the risk factors, management discussion, and financial statements, which is the accounting stuff I promised your accounting professors. So we'll detail that. So let's do a live walkthrough. If you guys want to do this on your laptop or phone or anything, you can do it. What you're going to do is search Apple Investor Relations. Enter. You go here. Now there's this nice, pretty website. You can click on the SEC filings. Once you're here, you have all these SEC filings. You have Tim Cook. What a guy. You can click on the annual filings. On your annual filings, you'll see the annual reports from the last so many years. what is this, 1994. Let's go to the beginning, or let's go to the most recent one. So the 10K annual report from November 1st, 2024, just 5 days ago. Wow, perfect time. So let's open that PDF. When you open it, you'll probably see this number and it freaks you out. 121 pages. Who's gonna read through 121 pages of this long, super boring legal report? Definitely not me. I don't want to do that. I have better stuff to do with my time. So let's look at the fundamentals. What do we have here? Investor relations and business overview. So we find the table of contents. Now let's look at the business overview. This basically tells us, what does Apple do? I'm sure a lot of us know what Apple does, but we can see the company background. It designs, manufactures, and markets smartphones, personal computers, tablets, whatever. These are the different products. You can see their services. Not many people know Apple's making money from services versus just their products. Digital content, payment services, cloud services, AppleCare, advertising, different segments, markets and distribution, competition, whatever. That stuff is really important to look at. The number one thing when you invest in a company, learn what the company does. Just because the company has good fundamentals or good financials doesn't mean you should invest in it. If you're investing in something and you don't know what it does, why are you giving them money? Right? If I'm gonna invest in an athlete and he's getting good scores, but I know he's a terrible person, do I really want to invest in him? Probably not. Learn what the company does. That's a really important factor. If you like their product, if I like an iPhone, if I can't live without an iPhone, hundreds, thousands, millions, billions of people probably can't either. So it's really important to learn what the company does. Next, the risk factors. What are some risks to consider for Apple? This lays it out. Macroeconomic and industry risks. The company operations and performance depend significantly on global and regional economic conditions, and they can affect the company's business. Yeah, that's pretty obvious. I mean, macroeconomic indicators affect everything. They affect how much money is going in my bank account. They affect every single company in the world. Macroeconomic conditions are the base of everything. So pretty obvious. Let's look at some more. The company's business can be impacted by political events, trade, and other international disputes. I'll point this out later throughout. Apple's sales have been struggling in China. So maybe these these import taxes and tariffs will be worse for Apple in the future. They're already struggling in China. Now if we add more imports or even taxes on, maybe they'll be worse. Or actually taxes on imports might not affect them. Yeah, never mind, scratch that thought. But we obviously saw that Apple stock did react very positively to Trump's administration. So there are some other factors to consider. Let's look at some more. Global markets for the company's products and services are highly competitive and subject to rapid technological change. I don't know if you guys remember a phone 10, 15 years ago. It didn't look like this. It flipped open, it had a keypad, definitely not 2 or 3 cameras on the back. This sector is seeing a lot of technological change. In our generation, in our century, in the 21st century, technology is the face of our century. We're seeing a ton of technological change. That's a huge risk to consider. Apple needs to stay innovative with their products. They slow down for a second. Samsung, Huawei, Google Pixel, whatever, all these other brands are competing with them. They're going to go ahead. So this is a huge risk to consider. Let's look at one more. To remain competitive and stimulate customer demand. Customer demand is always a risk for every single company. You might think you have a great product. Do the customers think that? Personally, I hate an Android. I would never buy an Android in my whole life. No matter how good the camera is, I don't want a green bubble. So customer demand is also a really, really important factor to consider with every product. Okay? Now let's look at the management discussion. This is a very, very cool part of the annual reports. You can find it here at the Management Discussion and Analysis of Financial Conditions and Results of an Operation. The management, so the C-suite executives, they give insight onto their analysis of the company. So all these C-suite executives are given their opinions and insight analysis on Apple. So one, you can find the new products. This year, they released these new MacBooks, iPad Air, iPad Pro, whatever. Macroeconomic conditions have indirectly impacted and in the future could materially impact Apple. How is it operating across the world? We can see the net sales for 2024 compared to the net sales of 2023 and 2022. All of the countries or all of the geographical locations are positive, except in China, they're down 8%. So Apple's sales in China have been very, very poor. Let's look at why. Greater China net sales decreased in 2024 compared to 2023, due primarily to lower net sales of iPhone and iPad. The weakness in the, I don't know what that means. Oh, is that the currency or something?
Yeah.
That's a currency. Relative to the dollar, had an unfavorable year-over-year impact on the Greater China net sales. So the weakness in the currency relative to the dollar impacted the sales. I probably wouldn't have known that if I didn't see this investor relations page. I mean, I didn't even know China's currency was that. So Max probably knows more than me about this, but it's really important to consider this stuff. So this management discussion is a really, really cool place where you can find all this insight. And lastly, the financial statements. Whoever's an accounting major probably knows more than me about this. So I don't want to go a little too in detail, but I'll give you some of the financials I look at and how I interpret them. On every annual report, you'll see the income statement, the balance sheet, the cash flow statements. I know whoever's in accounting probably hates these three statements. I hated it too. Super boring shit. I mean, no one wants to learn about income statements, balance sheets, cash flow all day, unless you're an accounting major, which I'm sorry. But anyways, you can find the income statement here. We have the net sales, the cost of sales, operating expenses, operating income, earnings per share. The main things to look at, total net sales. How is it growing year over year? So we see September 30th, 2023, it was 383 billion compared to September 28th, 2024, 391 billion. So it's growing. Good sign. Now let's look at the cost of sales. Total cost of sales have also decreased. So their expenses or the cost of sales is decreasing. Another good sign. So their margin, the difference between their total net sales and their total cost of sales, is also increasing. So a company wants to increase their margins. You want to have good margins. If you're making $383 billion in sales, but your cost of sales is $400 billion, you're losing money. So you want to maintain those good margins. One thing I like to look at is research and development. I noted this a couple minutes ago early in the presentation. What is the company doing to grow? I actually like to see the research and development costs or expenses increasing over time. That's my preference. Because that means the company is investing more into research development, growing in the future. So we can see that Apple is investing more in the research and development. They're growing more. And then you can also look at the net income. If you do the total income minus the total revenue minus total expenses, you get net income. Apple's net income has actually decreased year over year. So some of their operating expenses has increased, making their net income decrease year over year. Still, net income positive, which is a good sign, but they have been slowing down a little. And then we can look at the earnings per share. Max mentioned the earnings per share earlier. It's basically just the net income divided by the shares outstanding. Now you might see the basic and diluted over here. Anyone know the difference? So diluted shares refer to the shares not yet issued. So for example, if you work at Apple, you might be compensated with some stock. Say you did good, or you get a bonus at the end of the year. You might get compensated with some stock. It's not yet issued yet. So diluted takes into account the shares that have not yet been issued but will be later. So it's a little more accurate. That's why you won't see much change between the 6.11 and 6.08, but we like to use the diluted because it is a little more accurate. So you can calculate that over here. Now let's look at the balance sheet. In the balance sheet, I know all the accounting majors see the assets equals liabilities plus shareholders' equity. You probably love that formula. That's like heaven to your ears. But let's break it down a little. You can see the current assets, so all the assets in the short term, 12-month period, the non-current assets, so the long-term assets that Apple's holding, current liabilities, non-current liabilities, and then shareholders' equity. One of the main things I look at here is the current ratio. How do the current assets compare to the current liabilities? So you definitely want to see a positive sign. We can see current assets, 152 billion compared to 176 billion current liabilities. So it's actually less than 1. So I think the general consensus is you want to see that above 2. Apple's is less than 1, which is a little short, or a lot short. Next, you want to see their cash holdings. You want to make sure the company has some cash on hand. Just in case something bad happens, you want to have some cash on hand. So Apple has $29 billion on hand. Pretty big number. Now we can see the capital expenditures. How is this company investing their capital into these expenditures? So their capital expenditures are growing over time. We can see the total debt to equity ratio. I know a lot of you guys use this in your accounting classes. We can compare the total debt to the total equity. This is stuff you can analyze on the balance sheet. And finally, we have the cash flow statement. This just compares the cash coming into the company as compared to the cash going out of the company. I don't look at this too much. I'm not an accounting guy, but the main thing I look at is, the operating cash flow and the free cash flow. So you can find the cash generated by operating activities. If you subtract,
I have a question.
Go ahead.
What's the point? Like, basically, why would I invest in a single issue, like a single stock or type of stock? Well, why wouldn't I invest in an index fund in comparison? It would save me a lot of time looking at these financial balance sheets, first of all. It would also save me a lot of time and spread out my money so that way if Apple falls, because Donald Trump tried to put a 60% tariff on China, which is, Apple's main manufacturing center, and that hurts Apple's bottom line. Shouldn't I rather just save all this trouble and invest in an index like QQQ, for example?
Absolutely agree. I'm 100% with you. That's what I'm doing with my portfolio right now. I used to hold individual equities. I'm switching to all index funds now. Saves a lot of time. You get better returns. Not necessarily, but you match the returns to the market. It's a lot safer. You have a diversified portfolio and you're matching your returns to the market. You don't have to do all this annoying, hassling, a lot of research and time. For those who want to try to beat the returns to the market or just want to learn this for their own general purpose, you can practice fundamental analysis. If you just want to match the returns to the market, you can just invest in an index fund. Warren Buffett, some of these big investors, if you track the politicians, Nancy Pelosi, some of the politicians, they're beating the returns to the market. So they're performing fundamental analysis. So maybe Nancy Pelosi is doing insider trading, who knows. But they're doing fundamental analysis and finding out what are the fundamentals of a company. So later in your life, or if you want to practice now, you could do it. But I absolutely agree with you. Investing in an index fund is a lot safer, a lot simpler. You get a diversified portfolio, and you match the returns to the market. I'm just doing a walkthrough just in case you want to learn this. I think it's really valuable information to learn. So I look at the free cash flow and the operating cash flow on the cash flow statement. You can find it by looking at the cash generated by operating activities and subtract it by the payments for acquisition of property, plant, and equipment, and get the free cash flow. So we have the current ratio, we have the debt to equity, we have free cash flow, operating cash flow, ton of ratios. Say you don't want to do all this math by hand. Say you just want the numbers, you don't even want to look at these financial statements. You can go to Yahoo Finance. On Yahoo Finance, one, you can find the financial statements, income statement, balance sheet, cash flow. You can also just see the numbers and statistics. So there are a couple here, PE, trailing PE, forward PE, market cap, whatever. If you want some more, profit margin, operating margin, ROA, ROE, revenue, EBITDA, gross profit, diluted EPS, total debt, total debt to equity, current ratio. They have all these different ratios, all these different numbers that you can use. So if you don't want to do all this going through the financial statements, you can just find it on Yahoo Finance and interpret it. The one reason I do recommend looking at the 10K is for these, the business overview, the risk factors, and the management discussion. That stuff is a little harder to find on Yahoo Finance or other sources. You can find it really neatly laid out for you on the 10K. These are audited reports, so everything will be factually correct on these reports. So I strongly recommend looking at the 10K or the 10Q to go through the business overview, the risk factors, the management discussion. Yeah, and now Max is going to talk a little about the CQA challenge. As you probably know, PPM is representing 2 teams for St. Louis University competing in this international CQA challenge. We have Jonathan Chang here, Dhruti, Shivani, Luca, Masis. Anyone else I'm missing that's on the team? I think that's everyone. Yeah. All of us are competing we're representing SLU in this international challenge, so Max is going to walk you through a little bit about our strategy in the CQA challenge.
Yeah, and so essentially what this challenge is they give us a portfolio to manage, and they give us $1 million in long stocks and $1 million in short stocks. And the requirement is to constantly have 40 long positions and 40 short positions every single week. So that's a lot of stocks. 8 stocks is a lot of stocks to do research by hand. So that's why we have FinViz. So through FinViz, we first screen stocks based on certain qualities and attributes that we're looking for. And one of those is how big the stock is. So if you can see in this circle right here, about 70% of our portfolio is in small cap stocks. That's stocks under 2 billion, I believe, market cap, and 22% in mid cap, and only 6% in large cap. And normally for a portfolio, you want to be mostly invested in large cap stocks. That's what most S&P 500s, most ETFs do, because these stocks are more consistent. They are really big, have good fundamentals, and are going to net you returns over time. However, for this competition specifically, this is only over a couple months. So in order to generate the most profit in a few months, we are taking a little more risk, and also this is not real money, so there's not really a downside to this, but we're taking more risk through small cap stocks in hopes that they're going to be able to generate us more money, so that way we have a better chance of winning the competition.
Yeah, you may be thinking like, Sanj, Max, this is exactly what you guys are preaching against in PPM. You guys are always saying invest in large reputable companies, invest in index funds, but here you're preaching your strategy of investing in small caps. It goes completely against your word. One thing to note is in our personal portfolios or retirement accounts, or maybe someone will have a 401k, whatever, you're investing over a long period of time. I'm not trying to cash out this money in 2 months. I'm investing for a long period of time. So I want these large reputable companies that I think will grow for a long period of time. In the strategy, the first round is 2 months, the second round is 2 months, and the third round is 2 months. That's not a long period of time. That's a very short period of time. So we're investing in some smaller caps for some elevated risks to try to get some good returns in the short term. It's not something I'm very comfortable with. It's not something I practice, but it's good to practice some new strategies.
And another thing that you can apply to your own personal portfolios is diversification. So as you can see, this highlights all the sectors that we're currently invested in through our portfolio. And we're invested in a variety of them, as you can see. And the reason you do this is because even if one sector has a bad day, like just last week, a lot of the tech stocks weren't doing so well. If one sector goes down, you still have a bunch of other sectors keeping your portfolio up and mitigating as many losses as you can, while also investing and hopefully getting a lot of return. But and a question you might have is, why don't we just invest in ETF? For this challenge specifically, you're not allowed to invest in ETFs and index funds, but for your personal portfolio, it's much easier to do that because it'll diversify your money for you without having all the added work and research that comes along with investing and researching this many sectors.
Yeah, 100% agree. When you invest in different sectors or diversify your portfolio, you're minimizing risk while maximizing returns. In my finance class, is anyone here a finance major? Have you guys learned about ORPs? ORP? I know Dhruti did. We had an exam about this yesterday. It's literally about maximizing return while minimizing risk. So there's a Sharpe ratio, all these different ratios. But essentially, the less correlated stocks are, the less correlated they are, the better chance you have of making returns.
What do you mean by correlation?
For example, stocks in the tech sector. If I take, I don't know, Apple and Samsung, they're very correlated. If Apple goes up, Samsung's probably going to go up. If they're negatively correlated, I don't know, say like Apple and McDonald's or something. If Apple goes up, McDonald's probably won't change, maybe McDonald's will go down. Those don't have much correlation, so that's diversification. So the more diversified you are, less risks you have, more chance of returns or maximizing returns. So diversification is so important. When you buy an index fund, when you invest in an index fund, you're investing in the whole market. You're investing in tech stocks, you're investing in communications, you're investing in consumer cyclical, you're investing in financial services, whatever. You're investing in the whole market. So you're investing in a diversified portfolio through index funds. So it's really, really important to diversify your portfolio. And then lastly, I want to talk about our meeting on Monday. I don't know how many of y'all have taken Dr. Mark Painter. He's a fantastic professor. He can't come to our PPM meetings because his son has soccer games every PPM meeting. But he's actually our faculty advisor. He's giving a lecture on quantitative analysis on Monday, 6 to 7 p.m. in the B School auditorium. Personally, I don't know much about quantitative analysis. I know it's something to do with like a lot of math and statistics. I couldn't tell you anything about it, to be honest. So I'm going to be with you guys taking notes during the lecture. Strongly recommend attending. It's good to learn different strategies. I don't know anything about quantitative analysis. I don't know anything about technical analysis. I know Jonathan here knows way more than I do about that. It's good to learn different strategies, practice new things, figure out what your risk tolerance is, figure out what strategies you like. Maybe you don't like looking at the fundamentals, maybe you like looking at the technicals of a company more. You like looking at the patterns. A lot of people like doing that. I like fundamentals. I have a lower risk tolerance in technical analysis, but Dr. Painter is going to teach quantitative analysis. Really, really, really recommend coming out on Monday for that. Yeah, that wraps it up. Do you guys have any questions? Okay, if not, we'll probably be back in the auditorium for the rest of the semester. I think we have 3 meetings left. We're going to wrap up fundamental analysis. We're looking for some e-board positions. I know Shivani wants to do some fun little activity at the end of this PPM meeting. So if anyone wants to stick around for that activity, go talk to Shivani. All right, thanks for coming out.